Hey Nick, how you doing today?
Good, Dave. How about yourself?
I am doing well. All ready to get rolling with the fourth edition of our podcast.
Episode 4. I think this is the
Epis.
one.
Yeah. Feel like
Best one
maybe
yet.
we're gaining some momentum, right? And we've got
Yeah.
a more fun topic today than we have on the last couple. We're going to talk about how to get started in your employer's retirement plan. And because when folks come to see us, a lot of times we see hesitation around how to get started. So we were going to kind of talk through that and some of the issues people need to think about. And hopefully, the main takeaway for most people is if you've been procrastinating, just go get started. So
Absolutely.
yeah,
Um, yeah, so the big thing with this, there's a lot of different, I would almost even call it anxiety around how to get started, what to do, making sure you're doing it right. And what I tell people is just do some amount, just start out with something because something is better than nothing, even if you got, the type of contribution or the amount wrong. The point is to start making those contributions. And I always tell people the first contribution you make to a retirement plan is the most important because it has the
hmm
longest time to grow and compound. And so the sooner you can make that first contribution, the better. So even if don't worry about the details, just get some money in there, get it start growing, get that compound interest starting. That is going to make it easier for you down the road the sooner you can make those
right,
contributions.
right. And I always call it analysis paralysis. There's new topics, new jargon that you get bombarded with if you're a first time investor, and our tendency is humans is to freeze like a deer in the headlights in those situations. And so what we really want you to do is just power through, make some decisions, and get started. We can almost always fix and correct things as we go if you need to, but the main thing is just to get that money going and start taking advantage of the fourth wonder of the world of compound interest. Um,
Absolutely. And don't, the longer you wait, the more payrolls that go through, a
right.
couple different things happen. You don't get your matching contributions that maybe you're eligible for, but also it makes it harder, right? So when
Yep.
you're 3 months into a job and you start contributing, now all of a sudden you kind of have an idea of what your budget looks like. But
hmm
so it's much easier beforehand to take $50 and pay yourself first than it is to come back 6 months later and say, all right, now
Right.
I got to find a way to take 50 or 100 or $200 out of my budget now that I've been planning for the last 3 or 4 months on. So definitely
Yeah.
start right away.
Yeah, for sure. Once you're used to that paycheck, it's like someone's taking something away from you. But if you make those contributions right from the start, it's a lot easier to stomach. Um, and what we're hoping to do today is get people past that analysis paralysis. And I want to note too that we're talking in general terms here. There's dozens of different flavors of retirement plans out there, but they all tend to have these same basic functions. So hopefully this will help cut through that complexity so that you can move forward.
Absolutely.
Yeah. So, you got to start somewhere, and just getting money flowing into the plan is the way to get going. But you know, you've got to do a little homework as you get started, and we come back to this a lot with just about every topic we talk to people. But you've got to start by understanding where your money goes on a monthly basis, and it's a lot easier to carve out $100 or $200 or whatever you're going to put into the country is your contribution to a retirement plan if you know that you're not living beyond your means and you're not spending every last dollar that comes in when you get paid.
Absolutely. We talk about budget all the time it's one of those things that nobody likes to talk about, nobody likes to
Right,
deal with, nobody likes to sit down with a spreadsheet, but it's so important to everything that you do because
right,
you can be putting money in the right spots and have everything going with your retirement plan. But if you turn around and your budget isn't set, now you're taking out credit card debt and things like that, you can undo everything by making some bad decisions in the budget. So making sure you got that set up is extremely important when it comes to making sure that your contributions in your retirement plan are going to be successful, because success is not having to go back in there and take money and contributions out.
Yes. Yeah. And, after a while we sound like doctors talking about diets, but that's really the way it has to be. And part and parcel to that is, if you've got an emergency fund in place outside of your retirement plan, it's a heck of a lot easier to think of those contributions as being for the long term and for your later future than having to turn around and pull them out because your refrigerator died or your car needs a new muffler. So part of that budgeting process is to go ahead and get get some funds in the bank that you can grab, so you don't have to worry about the retirement account. With any of these plans, there's different penalties and taxes involved with distributions. Sometimes you can get around those depending on the situation, but I tell people, don't plan on, hey, if this happens, I can get that money out with no penalties or tax implications. Instead, think about it as the last resort, regardless of those rules.
Absolutely. Those things work much better when you can just let them grow and compound. And so that all starts with having the right budget and having that emergency fund in place.
Yeah.
So the next step in our process is determining your contribution level. And oftentimes we get questions around this in terms of how much should I be contributing. Rule of thumb rise that we talk about is 10 to 15% of salary. Now that doesn't necessarily have to be. So for example, if your company is generous enough to do a 5% match, and you're putting in 10, that gets you to 15, or if you're doing 5, that gets you to 10. So if you have a good retirement plan, some of that can come from on the company side. As far as a starting point that we always talk about, we never want to leave money on the table if we can help it. So if you have a company match at 8%, you want to do everything in your power to get up to that 8% as soon as you can. So whether that's taking step by step to increase that. A lot of retirement plans now will even let you automatically step up your contribution every year. So you might start at 5, then at the end of the year, they're going to push you up to 6 until you get to a certain point. And that kind of out of sight, out of mind is really helpful, because a lot of times you don't even notice that change is happening. And a lot of the companies are trying to go around when their kind of annual merit raises are as well. So you might get a raise of 2%, you might contribute 1% more to your retirement plan, and it still feels like you have more, or you still have more in your paycheck, even though you put a portion of that towards retirement, which is really good. So,
It fits with what we talked about in the first point about getting started in the plan before you're used to what a certain level of take-home pay is like. And if you get that increase in pay or a bonus, that's a great time to raise your match, because if you haven't had it in your bank account, you're not going to miss it as much. It's just the way psychology plays into this. And keep in mind 10 to 15% is a target. But this also is a long-term goal, and it's not like, if 10% of your salary is going to put you in a real cash flow bad spot right now, start with what you can, do what you can, and work up from that.
Absolutely. Just that kind of consistency, getting used to putting money in there. That's really important. One of the other side notes to that is, a lot of people, if they, let's say you got a job, they have a retirement plan, you're not planning around sticking around very long. A lot of times I would have employees say, well, I'm not going to be here, so I might not get this match, and I'm just not sure about things. I have yet to have anybody that I told to make a contribution come back to me and say, man, I really wish I wouldn't have done that.
Well, and have you ever had a retiree come back and say, boy, if only I'd saved a little less?
Oh yeah. Exactly.
Right?
Never. Not
Yeah,
to this
right,
day. So
right. I just wish I had not put away. That's different from regretting that you didn't do certain things throughout your life. But nobody's ever said, "Boy, I just wish I had a little bit smaller 401k."
right.
So, yeah. So some plans, but not every plan, now has a choice of contribution type, and this can get confusing to people that aren't used to this sort of system. The traditional way, and sometimes you'll hear it called a traditional contribution for retirement plans to be funded, is what we call a pre-tax contribution, where your contribution is subtracted from your gross pay before your taxes are calculated. And so you get the benefit now of not paying tax on that money, but then in retirement, that money's taxed when it comes out of the plan. And with the basic premise that most people are going to be in a higher tax bracket during their working years than they are during retirement. But we know in reality that's not necessarily the case, right?
Right.
So recently, we've seen plans bring in what are called Roth contribution types or post-tax. And what that means is that for those contributions, you pay the tax now. It's not subtracted from your income. But if you follow all the rules and take those contributions out during retirement, they're tax-free. So those are better if you're in a low tax bracket now and expect to be in the same tax bracket or higher in retirement. So it just, in a way, just begs the question, how do you know which is better and which is worse for your situation, right?
Right.
So we've got a few rules of thumb. I kind of draw the line if you're going to be in the 20%, 22% tax bracket or lower this year or now, you're probably better off making Roth contributions. It's not a hard and fast rule, but if you're in that low of a tax bracket, you're probably better off paying the tax now and having those distributions be tax-free in retirement. Do you have any rules of thumb you follow on that with clients?
Yeah, that's a good one. And actually, I think the younger you are, a lot of times leaning more towards the Roth. The problem is, as we've kind of described it, is nobody really knows
right
what the taxes are going to look like in the future. And so unless you were retiring next year and you knew your tax bracket was going to drop, off a cliff, which very rarely happens, having kind of a mix of contributions is my favorite thing, because once you get to retirement and you have some money in a Roth and some money pre-tax, then we have options. And the reality about retirement is most people are looking at a 30-year or more retirement. And so taxes are going to change in that 30-year time frame. And what might be a great strategy when you're first starting out in retirement might change down the road. And if you have both pre-tax and Roth after tax, we're going to have options. We're going to have to do some planning around that. And so mixing up the contributions is really helpful.
Yeah, you're diversifying the tax treatment of your money in retirement in the same way we would diversify your portfolio. And so there's going to be certain situations where it makes sense to take money out of a Roth during retirement, and certain situations where you would go with what you have in pre-tax or after-tax money. And when we've got that mix, we've got more arrows in the quiver to work with, and can save money down the road. And not only can you contributions or have different sub accounts in there, but you can actually, as you're contributing, you can say, if I'm contributing 10% overall, I want 5% to go into the Roth option and 5% to go into the pre-tax option. Right. Most plans are pretty flexible on that. So if you're lower income and you're just starting out, though, the Roth is probably the best bet for you. And
absolutely. Yeah.
Again, just don't get frozen by the decision. Pick one. You're not going to be too wrong one way or the other.
Absolutely.
That's kind of the key. These aren't life and death decisions. It's going to be a good thing regardless.
Making contributions is always better than making, whether it's pre-tax or Roth, it's better to make it than it is to, not make it. So
sure. Yep. Couldn't agree more.
So the next little bit of thing that you have to decide is choosing investments. And so this time, we talk about analysis paralysis. There's typically, a lot of different options when it comes to even the 401k.
Yeah.
And a lot of companies have even slimmed them down because they found that the more options that were out there, the less likely people were to participate, which is not what we want. And so they've kind of really slimmed it down in terms of what your options are available to you. And like we note here, it's just really important to kind of pick something and make contributions more than it is to get it right. And so, as rule of thumbs, the younger that you are, you really want to be a little bit more aggressive, and when we have a rule of thumb, when you're looking at things from this standpoint, a lot of times we'll say, whatever your age is, that's what you want to have in safer investments. So if you're 25, you only want to have 25% in bonds or safer investments, 75% into stocks. And as a rule of thumb, that kind of helps.
Yeah, it does help. I wasn't a great math student in elementary school, but one thing that always stuck with me is 0 times anything is still 0. So if your account balance is 0 and you're just starting out, whatever the investment return is, doesn't really matter, right? 0 times whatever percent you make on it is still 0. So when you're getting, it's being a little bit tongue in cheek, but when you're just getting started, what the investment return isn't nearly as important as the money going into the plan. Your contributions in your first year, if you're putting, say, 10% of your salary in, are going to be more than whatever the investment return is. And that's going to be true for a long time as you're just getting started. It's not that it's not important. You still want to earn a good return on your money, but to get stuck on the decision making is just not worth it. So there you are, though, with a whole laundry list of funds on this sheet, and you've never invested before, and it might be in Greek as far as that goes for most people. When somebody brings me their plan options and they're just getting started, I often look for low cost diversified index funds. But if you don't know what you're looking for, that can be kind of tough to decipher.
Right, and not every plan has those in the plan.
Right.
So, that's kind of a challenging thing too. And not only do you have to have the right kind of the right options in terms of what type of stocks, but also you got to look at what the costs and things are, and not every plan has that. And so target date funds really solve a lot of this problem because they're typically on the lower side when it comes to fees, and they're well diversified.
Yeah. So a target date fund is a mutual fund that is designed to be a one-stop shopping kind of fund where the date that is in the name corresponds roughly to when you would expect to retire. And so what you're doing is essentially telling those fund managers, take care of my money, knowing that right around 2050 or 2060 or 2030 or whatever that target date is that's in the name of that fund, that's about when you plan to retire. So if you're younger and that target date is a long time out there, the fund's going to take more risk with the idea that you've got time to earn a good return with that money. And then that risk becomes less as you get closer to retirement.
Right, and especially when you're younger, I mean, those are typically built into 5-year increments, and so as long as you're within 5 to 10 years of when you actually retire, because who knows what the future is going to hold, you're going to be fine for a long time. Now, when you're 1 or 2 years away from retirement, it kind of changes things a little bit because it's harder to kind of predict. But when you're young, for sure, those are you don't have to be exactly on.
A lot of investment advisors don't like to recommend target date funds, but I look at them as if I only know one thing about a client or somebody that we're talking to, and I may never see them again. If I know that their retirement money is in a target date fund, at least I know it's going to get them close to what they should be in.
Right.
for ongoing clients, people that we're working with, often depends on the plan. Some plans have really good funds in them that we can build a great portfolio out of. Sometimes the target date fund is still the best. But if we never see somebody again, we know that that's going to take care of business for them.
Right, exactly.
So, and one last thing on those is now those are usually the default. So if you sign up for your plan and you don't choose a fund, you're probably going to be put into a target date fund that's going to be geared around when you would turn 65.
Right.
So, so you may end up, if you don't make a decision now, you may end up in one anyway, and that's fine. It's absolutely fine.
Yep.
So
for sure, just making sure you're getting those contributions in there, like we said, is much more important than the investment lineup.
Yeah, and now, probably the hardest part for new investors, just keep contributing consistently and ignore the markets. The markets are going to go up, the markets are going to go down. That is as close as I will come to a market prediction. They will be up and they will be down, but over the long haul, they'll be up. And it's interesting to see younger folks that are just starting out in plans like this will get very upset when I will hear, I've been contributing for a year and I have the same amount in there as I started with, or less even, and they'll get discouraged and want to stop and not have the perspective of thinking of this as like a 30-year game where what they're putting in now and what it does in the short term isn't really going to matter. Yeah. I'm sorry.
Absolutely. So what I would also say to that too is a lot of times, what you were taught about the markets or investing is really going to kind of show through in times like this. And the hard part about where we are at today is sticking it in a savings account or the most conservative investment. Unfortunately, you're not getting enough return when you're young. Mm-hmm. And if you think about, what or what you learned about the stock market, probably wasn't very much. If you were lucky, you had a class in high school or college. Right. Other than that, you might have learned something from your parents, but a lot of times you didn't learn things from your parents and you didn't take a class. And so all you remember is that in 2008, we had a big, huge stock market crash, and that probably made, without getting too much into behavioral finance, but that probably made you think that, stock market investing is dangerous and you can lose money. And the other thing that you probably remember is Occupy Wall Street. And so you have some pretty bad things that you remember about investing in stocks. Right. And so if that's what you're going on and you tend to be more conservative, then you're going to have a hard time getting the growth that you need in order to retire because interest rates are so low right now. And so really kind of looking at, and it goes back to that consistency and making sure that when the markets are up and down, you're not panicked. You've got plenty of time to make it up when you're just starting out and you're young. So don't worry about that stuff. Just keep contributing, keep putting money in there, and eventually it will come back, and it will come back stronger because you've been putting money in along the way.
Right. Well, we could do several podcasts just on risk in the markets and different things to think about. But at the beginning, when you're starting out, the main thing people lose sight of is if the market goes down and you're putting a couple $100 in every month from every paycheck, you're buying more shares. And so when the market does come back, you've got a bigger accumulation of those shares now at a higher price, and it compounds your gains. It's actually the best thing for people when they're just starting out for the market to go down. It feels so counterintuitive, but it really is. And I guess we'll have to throw that on our board to talk about in a future episode. But it really does work out in your favor to have the markets go down while you're contributing. So
yeah, and you're right, so counterintuitive, but in 2008 I was I wish for being able to get back in at those prices. I was young, I was putting money away in my 401k and prices were low and things turned around and it's gone really, really well, and so it's just that mentality you have around those things.
Yeah, I've thought it'd be a fun like research project to go back and get my own 401k statements from 2007, 2008, 2009, and 2010, and show that those contributions that I made in those years when everything was so scary and lousy are actually what has driven my account value since then, in a very positive way. So don't lose sight of that. Don't worry about it. Throw your statements away if you have to. I used to tell people in 2008 I was going to cut their cable TV and pull their statements out of the mail so they quit looking at it. It's the best thing. It really is the best thing.
Absolutely.
So, we'll talk more about that in future episodes. I have no doubt. Yeah. It's one of our favorite topics.
I'm looking forward to your research project. I'm not sure if I'm going to be more excited about the research or that you found those statements from back then.
Right. Neither one is probably very likely. Okay, so we'll find a different way to tackle that topic.
There you go.
And
I think lastly, just kind of recapping everything, and if don't be afraid to ask for help. I think that's the big one. Most of these plans have somebody that's available to you, whether it's a 1-800 number, whether it's someone that's coming into your office on a regular basis. Reach out to them or reach out to a local financial planner, advisor. You're just getting started. You probably don't have a ton of money when you're getting started, but I know at our firm, we definitely take the time to make sure that you understand what's going on and make sure that you're set up on the right foot and comfortable in that, because you are the future, and being able to invest and get you on the right path is, love helping people, and we love helping people that are just getting started, just to at least get them out on the right foot. And money that you spend doing that and getting set up properly, that's an investment in your future. So that's, it's really going to help you to get set up properly, to understand exactly what you're doing and making sure that you're doing things right. Is really going to help you over the long term, because you're going to be able to do the things that we talked about, right? You're going to be able to consistently invest and not worry about the ups and downs of the markets, because you've had that conversation. You understand things better now. You're going to be in the right investment. You're going to make sure that you're making the right types of contributions. And making sure that you're contributing at a level that should give you options when retirement age rolls around. So you're going to be able to retire. All of those things you can really get, and that's money well spent in talking to an advisor and making sure that you kind of have things set up properly and you understand them, so you can stick with it and continue to roll and continue to contribute. I think those are really, really good reasons to really good ways to spend your money.
Yeah. And, there's lots of good sources of help. I always tell people too, though, especially in retirement plans, beware the water cooler talk, particularly when it's about the markets, back to our last point. But, just remember that the person in the next cubicle over or the next desk over or wherever you happen to be, their situation is different. So don't just assume that because they did a certain thing, they did what's right for you. And,
that's a great point, Dave. Make sure that you're talking to an expert, and one of the things, I'm stealing your line here, but just because it's a simple solution doesn't mean that it's necessarily a bad solution for you. It might be the exact right one. So you don't have to be getting in and out of this specialty fund in your 401k. You can be in the target date retirement fund and be perfectly fine, and that might be the very best thing for you.
Well, yeah, and to steal from Warren Buffett, that I do quite often, if you're doing it right, your investments should be boring, right? And so if don't get caught up in what the news of the day or the hot topic or what a particular fund in the plan did last month that you might have missed out on. It's the long haul that matters, and boring is probably the best way to go. So
it worked for Warren Buffett, so
right. Yeah. We're gonna have to put like a counter of how many times I quote or bring up Warren Buffett on episodes in the future, so that we don't get carried away. But all right. Well, I think we've covered that topic pretty thoroughly. I hope this helps our listeners to get pointed in the right direction and not be afraid to jump in there and get going.
Absolutely. And if you're listening, make sure you subscribe and, rate our podcast. If you have questions about any of this, feel free to reach out, shoot us an email, give us a call.
Yeah.
Love to help.
And we'd love to get ideas for future topics. So
absolutely.
Don't hesitate to speak up. Love to hear from you. All right. Well, I'll talk to you later, Nick.
All right. See you, Dave.
Thanks. Bye.